What if I told you that market volatility isn't your enemy, but your greatest opportunity to build wealth? Most investors panic when markets fall. They stop their SIPs, withdraw investments, or wait on the sidelines, fearing losses. They believe they are protecting their money. But what if this reaction is actually costing them wealth? What if instead of running from volatility, you could use it to accelerate your financial growth? Hi, I'm Jiten Modi, your personal finance strategist. Over the last 2 decades, I've helped individuals and families navigate market cycles with confidence. I've seen the mistakes people make when markets turn unpredictable. I've also seen how investors who stick to their strategy, even in tough times, come out far wealthier than those who react emotionally. The truth is, market volatility is not a problem. It's an opportunity. If you know how to use it correctly, you can turn every market dip into a stepping stone for long-term wealth. But most people don't. They pause their SIPs, stop investing, or even withdraw funds, thinking they are avoiding risk. In reality, they are missing out on one of the most powerful investing advantages: buying more units at lower prices. Let me explain how this works. Imagine 2 investors, Amit and Rahul. Both start investing Rs 10,000 per month through SIPs. The market goes through a downturn. Rahul panics. He stops his SIPs, waiting for stability. Amit does the opposite. He continues his SIP and even increases his investment. When the market recovers, Amit sees massive gains. Rahul, on the other hand, re-enters at a higher price, reducing his long-term returns. This is the power of discipline. This is the power of staying invested. The biggest advantage of systematic investment plans, SIPs, is rupee cost averaging. When markets fall, your SIP buys more units. When markets rise, those extra units generate higher returns. If you stop investing during downturns, you miss the chance to accumulate units at discounted prices. Let me share a real story. Priya, one of my clients, started investing in SIPs in 2010. In 2020, when the market crashed, most investors were pulling out money. But Priya followed the strategy I'm sharing with you today. Instead of stopping, she increased her SIP contributions. She knew that the best time to buy is when prices are low. 2 years later, her portfolio grew significantly. On the other hand, Ramesh, another investor, panicked. He stopped his SIPs. When the markets rebounded, he realized his mistake and re-entered at a much higher price. The difference between Priya and Ramesh: one trusted the process, the other let fear take over. So, what should you do during market volatility? First, stay invested. The worst mistake you can make is stopping your SIPs. Market dips are temporary. They don't last forever. But the investments you make during these dips, they can give you massive returns when the market rebounds. Second, increase your SIP contributions during market corrections. This is called the step-up approach. If the market falls by 10%, increase your SIP by Rs 2,000. If it drops by 20%, add another Rs 3,000. This allows you to accumulate more units when prices are low, maximizing your gains in the long run. Third, diversify your investments. Don't put all your money into one type of fund. A good SIP strategy includes large cap funds for stability, mid cap funds for growth, and debt funds for balance. This way, even if one segment of the market is down, another might be performing well, keeping your overall portfolio strong. Fourth, use a core satellite approach. Your core portfolio should be 70% stable. Long-term investments like large cap funds. Your satellite portfolio, the remaining 30%, can include mid-cap and small-cap funds that offer higher growth potential. During market downturns, shifting more funds into your satellite investments can boost long-term returns. Fifth, consider a systematic transfer plan, STP, if you have a lump sum amount, but fear investing during volatility. An STP allows you to invest gradually. Your money is first parked in a liquid fund and then systematically transferred to an equity fund. This minimizes the risk of investing everything at a market peak. And finally, have a financial safety net. Investing in volatile markets should be done with proper risk management. Keep at least 6 to 12 months of emergency funds in a liquid or debt fund. This ensures that market downturns don't force you to withdraw your CPs at the wrong time. Let me share another example. In 2008, markets crashed globally. Investors panicked. Many stopped their investments. But those who continued their SIPs, who kept investing despite the fear, saw their portfolios grow exponentially in the following years. History has proven time and again that markets recover. The key is to stay invested long enough to benefit from that recovery. Think about the biggest companies today: Reliance, HDFC Bank, Infosys, TCS. Their stocks have had multiple ups and downs over the years. But over time, they have created immense wealth. Imagine if an investor had stopped investing in these companies during downturns. They would have missed out on incredible growth. Market corrections are not a reason to stop investing. They are a reason to invest even more. Let's address a common concern. What if the market crashes completely? The truth is, markets have always recovered, no matter how bad the crash. Whether it was the 2008 financial crisis, the 2020 COVID crash, or the many corrections before and after, markets always bounce back. And investors who stay invested always come out ahead. The biggest mistake you can make is letting short-term emotions dictate long-term financial decisions. So, what's your next step? If you are unsure about your SIP strategy, let's fix that today. Book a free clarity session with me. We'll analyze your investment portfolio, identify areas for improvement, and ensure you are maximizing your returns in all market conditions. Want to dive deeper? Download my free ebook on SIP investing. It's packed with real-world strategies that top investors use to create long-term wealth. Or join my private WhatsApp community, where I share expert financial insights. Your number stays private, but your learning becomes personal. Comment clarity to book a session, ebook to download the guide, or community to join the WhatsApp group. The links are also in the description. Market volatility is not something to fear. It's something to embrace. The question is, will you take advantage of it? Or will you let it scare you out of wealth creation? The best time to invest was yesterday. The second best time is today. Take control of your financial future and make volatility work in your favor. Start investing now and let's build wealth together.